Thanks for tuning in to our weekly investment briefing that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, as always, we're going to go ahead and start with our chart of the week. And we titled this one, Could This Midterm Year Be Different? So historically, midterm election years are somewhat challenging for the market. Many of the largest drawdowns we've seen have occurred in midterm election years. And there's actually a real reason behind this. It's not just kind of one of these weird anomalies that happens in the markets, but rather it's been driven by changes in monetary and fiscal policy. And what we're showing in this chart here is we're showing each year of the presidential cycle, what the market does on average, starting with the first year, then the midterm year, third year, and the fourth year. And that's in blue here in the top clip. And you can, in fact, see that the pattern has been more difficult in that second presidential year, the midterm year, than it has in the other years. And the bottom clip shows what monetary and fiscal policy has averaged during those years. And you can see that it's actually averaged quite a contraction in policy in that midterm election year. So we've had more Fed interest rate hikes in midterm years than any other year. Traditionally, fiscal policy is starting to roll off and be more restrictive. Now, the reason we ask the question, could this midterm year be different, is because we're actually expecting almost the exact opposite of those conditions. So the Fed does have an easing bias this year. They're predicting or projecting one interest rate cut this year. The market itself, what the futures are doing in terms of what investors are expecting, is pricing in three cuts this year. But regardless, there's an easing bias, not a tightening bias to Fed policy this year. And fiscal policy should be expansive, not restrictive this year, as those effects from the One Big Beautiful Bill Act start to really kick in here as the year moves on. So that's not to say that we can't have a challenging year, but the challenges are not likely to come from the traditional headwinds of tight monetary and fiscal policy. Rather, those policies are probably going to be more accommodative than they would be in a normal midterm election year. So, looking at some of the data last week, we saw that in December, we had about 50,000 jobs added to the economy, which is a pretty slow number of jobs. And you can see up here in blue the monthly change in non farm payrolls. And then the orange dashed line is the 12-month average. And you can see over the last 3 years how that's been declining. And as the job market kind of loosens up, there's been less jobs created each of these years. And last year in 2025 saw the fewest amount of jobs created really since the post-pandemic period started. So slow year of job growth. What's notable is that it is still positive, and there's other signs from the labor market that have been supportive. The unemployment rate had ticked up a bit last year, but it is stable at a low level still. And so that said, job growth is not moving fast, but the labor market isn't exactly cratering either. Another piece of data that's caught our attention is that the duration of the unemployment has really stretched out. So you can see that the median number of weeks that someone is unemployed right now is up to a little over 11 weeks, which is the highest really of this cycle since the pandemic. So fewer new jobs means that it is a lot more difficult and challenging to find a job if you were to lose one. And because of the softening in the labor market, that is a big reason why consumer confidence has taken a hit here. So in orange, we're showing the University of Michigan Consumer Sentiment Index, and you can see that it did tick up a little bit in the January survey reading, but it's still around its lowest level really ever. And this is something that does represent a risk and potentially an opportunity. So it's a risk if confidence stays low like this. Can consumer spending continue at its pace of the last few years if confidence doesn't begin to rebound? Not likely, but confidence could start to move higher as some of those stimulative effects from fiscal and monetary policy start to kick in. So that's something to watch. It's a risk, but also an opportunity to the markets. And when we look at the broad evidence right now, this is a really succinct view from our friends at Ned Davis Research that just kind of takes some really high conviction indicators on the economy that tend to be very timely. And it says, is that indicator at a level that's above trend growth? Or is it consistent with recession? And you can see here that most of these indicators are neither of those. They're not above trend, nor are they consistent with recession. Only one indicator is consistent with above trend growth, and one indicator is consistent with recession. So, broadly, we would characterize this as an economy that is growing at potential, maybe a little bit lower than potential, but not yet recessionary. Also, not really a breakout economic backdrop, really kind of a neutral economic backdrop. Now, when we look at what could be a risk to the markets this year, we look at valuation. So here we're showing the top clip the 1 year forward price to earnings ratio for the S&P 500, and the bottom clip shows the realized price to earnings ratio. So that's using trailing 12-month earnings, and on either account, we're above historical medians, and on that forward estimate, we're really up near levels that the markets really failed to push through from a valuation perspective. So, in other words, this is about as high as valuations get here on a forward basis. And analysts are expecting earnings growth of about 15% this year. Now, if valuations are up at their peak, we can probably expect valuations to come down a little bit from there throughout the year. And so what that really leaves is that leaves earnings growth to power the trend higher. We think earnings can grow this year and be solid, but we also think that that 15% number is likely too optimistic unless that fiscal and monetary policy really sparks consumer confidence to return. And actually, on average, what this chart is showing, it's comparing 1 year forward earnings estimates to what actually happened. And on average, analysts are about 8% too optimistic in any given quarter or for annual earnings. And so if you kind of feed that into numbers, you could go ahead and probably mentally subtract about 7.5, 8% from that 15% earnings estimate, which that gets you down to an earnings level this year of 7.5% or so. And that's about what you could maybe expect out of the market on a price basis, not necessarily total return inclusive of dividends, but on a price basis this year is about 7 to 8% appreciation in the market without pushing valuations even higher than they are right now. Now, that said, we look at market participation to tell us what the market actually thinks about all of this. And this indicator here in orange, this all this is measuring is the percentage of different sub-industries in the market that are in uptrends. So it takes something like the oil and gas industry or the software industry, and it looks at that industry and it says, is this industry in an uptrend? And right now, 71.5% of all industries are in an uptrend. So that's a relatively healthy number. Now, it has seemingly peaked. So that tells us that the market is getting a little more discerning over which industries and companies are rewarded. And that completely makes sense as the bull market has elongated. Investors do start to get more discerning. That's not an abnormal condition. But this is the type of thing we would look at to tell us that the market itself is becoming concerned over the economic backdrop or over the corporate fundamental backdrop. For now, the market is saying that everything is in decent shape. Now, when we look at performance so far on the young year, we can see that it's been a solid start for most asset classes. So here we're showing the S&P 500, which represents U.S. large caps, the Russell 2000, which represents U.S. small caps, emerging markets, developed international markets, commodities, bonds, and the dollar. And all of these assets have started the year positively, and leadership trends have continued to be international. So that's similar to what we saw in 2025. And we've had an encouraging start from small cap companies. Now, remember, small caps tend to be more economically sensitive, and they also tend to be more sensitive to financing costs or interest rates. So it would be good news if small caps could get going this year, and this has been a good start. So our closing thoughts for this week is we had our chart of the week. It shows midterm election years, and it does show that those have tended to be a challenging year. But we do expect a different fiscal and monetary backdrop this year than what the average pattern does show in a midterm year. Now, weak job growth and difficulty finding new employment, that's negatively affected consumer sentiment. And we do see that as a risk to the economic outlook in 2026. But we would also be remiss if we didn't say that there's opportunity there as well to get some improvements in consumer sentiment. Now, the broad package of data does suggest that we are in an economy that's growing at or maybe slightly below potential, but we're not yet near recession, which is important because as long as the economy is growing, we do expect that corporate earnings should also be positive this year. Now, that said, earnings estimates of approximately 15% are likely too optimistic, and stretched valuations do imply that there's little room for error there in corporate fundamentals. Now, we'll watch market participation here. That's going to give us those early signs that the market's disappointed in the fundamentals. And so far, technicals have been supportive for the bull market. We've had a solid start to this year with most asset classes trading higher, and small caps and international stocks have been notably strong. So that's what we have for you this week. And as always, I want to thank you for joining in and wish you a great week ahead.